Hey there, I'm Bethany McClellan with LCG Advisors, formerly Rapid Business Plans, and I'm here today with Heather Endresen from Viso Capital. Heather, so glad that we're chatting today because we had an interesting conversation just a couple of weeks ago, and you said something that really stuck out to me, and I really wanted to dive a little deeper and learn some more about your opinions because you had said this thing that we've been hearing about all this time, the Silver Tsunami, you said it's not happening. And so really want to know what makes you believe that this tsunami is not happening like people have been expecting all this time?
Yeah, I mean, I think first of all, the premise of the tsunami kind of makes sense. People are looking at statistics about the average age of a small business owner. It keeps getting higher and higher. I think it's, around 65 years old or maybe even older than that. So they're looking at all these really interesting statistics. They're kind of saying this is a baby boomer thing. They've been more entrepreneurial than other generations. And therefore, there's going to be this massive amount of businesses for sale as they go look to retirement. And so that all sounds good and seems to make sense statistically. But what we're actually seeing is that the stats that we really have to look at as far as how many deals are actually getting done, getting sold, businesses that are actually being sold, isn't turning into a tsunami. And the way we know that is by looking at the SBA data. At least with the SBA being a government program, that data is public. So it's not sort of an estimate or something we think is going to happen. We can actually see how many loans, SBA loans, were given for business acquisition each year, going all the way back to, I think, 2018. So I have a little chart I put together and I post it every once in a while on my social media, and it shows there's no tsunami. It's between 5,500 and 6,500 of these loans close every year. And sure, there's probably some that are done outside of SBA, but probably the majority of them are done within SBA. And if there was a tsunami, at least you'd see it there. So there's just numerically, it's not happening the way everyone has predicted it.
Well, and there've got to be some reasons for that. Thank you for, that answer, Heather. What are you seeing out there that is it deal quality, or is it people hesitant to sell, or is it businesses just shutting down? What are you really seeing that is contradicting the narrative here?
Yeah, so there's another statistic that sort of I think answers that question. And that is I've looked at a listing aggregator. I've asked them, where they pull all the listings from Biz Buy Sell and wherever else and put them on their site. And so I said, how many new listings of this size company per year do we see? And they gave me that number. And then I went and compared to how many SBA business acquisitions deals that closed. And what it tells you is only about 10 to 15% of all new listings that come out in a year are closing. And if you compare that to like the real estate market, for example, if you were looking at real estate listings, 90% of them are going to close. They're going to hit the right valuation somehow, and buyers are going to come along and buy them. In businesses, why are 85% of the listings not selling? That's the answer to why there's no tsunami. And it is because those are businesses that are probably not saleable, at least not in their current state. So they are maybe too owner dependent. They're not really transferable. The owner is kind of doing too much. Or the other reason I see that's pretty common is they think they think that the owner that wants to sell has a valuation in mind that's not realistic at all relative to their earnings. And so they go out and list and find out that they're not able to get that price. It's not going to be anything close to that. Those are two big reasons. There's quite a few more, but I think that's the primary problem is businesses. You've got owners who do want to sell, but they don't find out that they're not really saleable until they list their business on the market and kind of see that it's not going to happen based on the offers that they get or whatever the banks end up saying. So I think that's the primary problem.
Well, let's kind of break this down a little bit because is it really, I mean, we have a lot of listings out there. They're just not for saleable businesses is what you're saying. Is it a possibility that those could become saleable? Are they going to fail to change hands one day and just shut down? Or what is going to be the fate, do you think, of these businesses that were supposed to be part of that big wave?
Yeah, I mean, good. I think both of those things are going to happen. Some of them are going to shut down and some of them are going to become saleable. And there's a whole army of people out there and businesses out there that are trying to help those business owners become saleable so that they can hit their retirement goals. And, and that's a good thing. They have many options to become saleable and they can maybe spend a couple more years in the business. though, working on those things and getting themselves in a transferable position, improving their earnings, or getting the company to grow a little bit, maybe upgrading their systems and using more modern technology. But some of them are going to wait too long, or just never get to that, and they are going to shut down. And we see it every day where the only option is to close the business. And what happens when that takes place is their competitors just absorb their customers. And so it's a boon for the businesses that are around them, but no one got to buy a going concern from them, and they didn't get to get any enterprise value at the end of the day after all their work running a business.
What a shame.
Yeah.
Such a shame to see that.
Yeah.
And so we have certainly some problematic sellers, but from the buyer side, are there any problems that are coming from that side? Are we having maybe anybody that's not qualified or people that are a little idealistic? What are you seeing out there?
Yeah, so when we look at the buyer population, you can kind of sort them into two broad categories. And one is sort of the operators, or people who have experience and skill in certain industries, running businesses or running divisions of their larger companies that they might work for. And think of them as like their skill set is running the business, being an operator. And then we have another category of buyer that I'll call financial experts. They might have worked for private equity, or they might have even come from banking and developed a lot of skills around how to look at deals and kind of like deal making. But they're going to have a lot to learn when it becomes an operator. Each of them has their strengths and their weaknesses. What I find interesting is that more of the financial deal maker type buyers are getting deals done than the operator types, simply because they have that skill set, and then they have to learn how to be an operator versus the other way around.
Well, and that leads me to an interesting question. So who do you see that becomes more successful? Is it the operators that are more successful after a closing, or is it the finance people?
I don't know that I would pick one or the other. I have seen good and bad in both categories. It's really hard for lenders and all of us that are around this space every day to really pick that one thing that tells us whether this person is going to be successful with this business. It really varies by the individual and by the business. And frankly, I feel it comes down to grit, not necessarily what you have in your background, whether it be deal making, finance, or operator, but it's kind of more like a personality trait of, people who persevere and don't let anything kind of get in their way. They overcome adversity, that kind of thing. That's my own personal belief, is that you could be successful from either camp or unsuccessful, but it really kind of comes down to who you are as a person and whether you have that grit, I think.
Well, Heather, I think, if you and I could learn how to package and sell grit, I think we'd be in a different industry and be doing pretty well, I think.
Yeah.
Certain people have a knack for it, for sure. But tell me, how are borrowers standing out to the lenders today? How are you packaging your deals and telling the story to your bank partners?
The first and most obvious thing is just really good deal selection. They are being very careful about the deal that they want to move forward with. They look at a lot of deals, maybe even some LOIs that fall apart until they kind of find the one that feels like it's got all the right components to really work for them. So deal selection is probably number one. And then we work with clients to say, look, you've got to spend some time doing some diligence before you run to the bank. That's part of what my company helps them do, is sort of give them a safe space to start getting that initial diligence in, getting those first questions answered, and really making sure we understand where the strengths and weaknesses of that deal are. Then we are approaching the banks when we have something that we consider a decisionable package, but also something where we've worked through some of the bugs and the kinks, because there definitely are bugs and kinks in every single deal. Right after you sign an LOI, you learn a lot of things that you didn't know before that you might have to work through before you're ready for a bank.
And let's hope that some potential borrowers are in our audience today. What are some of the misconceptions of these potential business buyers that you're seeing out there? How can we set them straight?
Misconceptions, gosh. Some of it is just not kind of understanding which add backs. They're looking at these deals where there's a lot of things being added back to the cash flow. And there's this process that takes place where you, the buyer, have to decide which ones you believe are real. And then the bank is probably going to decide even fewer of those are real. And so I think there's a little bit of a skill set and a misconception that buyers have that they don't understand the bank's lens on those ad backs, and therefore they don't understand whether the deal is bankable at all, or if it is, what would the amount of loan be, that this deal could qualify for. So I think a lot of buyers have to go through a bit of a learning curve just on running the numbers, just how to do that, how to set the valuation, how to look at ad backs, how to categorize them. And I think that's probably the top thing that a new buyer coming to the space has got to learn.
Very good. And tell me, if we're looking down the road, maybe 3 to 5 years, how do you see this acquisition market evolving from what we see today?
I think what's going to happen, and this is because of AI and just my own personal use of it so much, that although the market's been slowly getting smarter, so that whole, we need to chip away at that 85% of listings that aren't saleable. That's, I feel like, the big rock that's in the middle of everything. And so the market has been slowly getting smarter. And the tools today, just the most recent versions of the different AI models are so effective that I think the whole market intelligence, is going to lift. Buyers are smarter, banks are smarter, and guess what? Then sellers and their brokers are going to have to get smarter if they want to sell, and they will. If your motivation is to sell, you will get smarter. So I think that's the next evolution, is everybody kind of getting on the same page a little more, so that more of the listings that come on the market are actually ready and can sell and have realistic valuation expectations.
Certainly, given enough time, every industry is going to, have some revisions and some upheavals. But tell me, what are some trends that some of our acquisition entrepreneurs should be paying attention to right now?
There are certain industries that become overly popular, I guess, as I think most buyers realize that private equity starts doing roll-ups in HVAC or something like that, even pool services. And it's hard to compete. If you're an individual buyer, you're not going to want to compete where an industry has suddenly become hot to a better capitalized buyer than you. So I think the trends to watch for is to kind of look for those hidden opportunities, those hidden industries that I've seen a few lately. I will throw a couple out there that are suddenly kind of on our radar and haven't been before. One of them is tree nurseries. Really interesting, kind of adjacent to landscaping space. Really, really interesting, especially in certain metro markets where there's a lot of growth. And then also grain elevators. I never thought I would look at a grain elevator deal, but I did look at, we're closing one right now. We've looked at a couple of others. And so there's all these niche industries that maybe have been overlooked. And so the trend is to kind of find those before they get hot. And that's where your best opportunities are as like an individual buyer versus a private equity buyer.
For as long as we've been in the SBA industry, we've been in the business of changing people's lives. Tell me about your favorite story of changing someone's life with the work that we get to do.
Oh God. I will say this. It is why I love what we do. It is really, it's wonderful to be part of somebody's transformation and taking them through kind of learning the basics to kind of the being in the thick of it in the middle of working on deals and then getting a deal closed. And what I do is I just keep in touch with all of my clients as much as they're willing to keep in touch with me. And I just love to hear their success stories. I'm thinking of one client, the deal was in Texas. They found the deal faster than anybody I'd ever seen. They closed a deal 5 months after they started searching. Really unique business. And today it is quite a bit larger. They kept it. They haven't even sold it. It's quite a bit larger. They have other people operating it. They've gone on into politics and other things that they're passionate about and for their families. And I look at the benefit of that one deal across their lives and their children's lives. And that I see that over and over, and I just love it. It's definitely what makes me really enjoy the work. It's not spreadsheets, that's for sure.
No, I've got actual goosebumps from that.
Yeah.
That's an amazing story. And that's just one story from like the hundreds and thousands. Very cool. So Heather, the SBA has effectively doubled the amount of capital available to some borrowers. What is the first major change you expect to see in the market over the next 12 months?
So what they did was uncouple the 7A 5 million from the 504 5 million. So now you can get 5 in 7A and 5 in 504. And therefore, if you maximize both programs, you could get 10 million. I think we still need the 7A to go to 10 million and the 504 to go to 10 million, but I know we need Congress for that. So that's not happened yet. This change that did happen, I welcome it. I think it's great, a great idea from the SBA. It's only helpful in business acquisitions for industries where either you're going to buy the real estate because you really need to, and the kind of the business and the real estate are sort of coupled together, or it's a heavy equipment type industry like manufacturing, where they have a lot of machinery and equipment that is 10-year or longer useful life. That's the only two cases. So we developed several use case ideas that we show to our clients. But many of our clients are not buying in those types of industries. So it's not going to help everybody, but it might help those types of deals basically finance a bigger deal, which is great.
For you, it'll be some niche borrowers,
Right.
and maybe for some CRE lenders, it'll be a different impact as
Yeah.
well. And my last question today is, what is one prediction about the SBA lending market that most industry professionals would disagree with today?
It's a self-serving answer, but I think that my own experience running a loan brokerage the way I do in a very niche pocket of SBA has taught me that I think the banks will eventually evolve away from a BDO model. I think that what I do is more efficient. I look at the amount of volume and clients were able to assist without, I don't have a BDO model, and I can do a lot of volume that way. And so I think that has taught me that eventually the banks are going to drop or diminish or change that model. It's a very expensive way to bring in business, and there is a better way.
And with that shift, how do you see everything falling out from that? How will the shops need to adapt in order to succeed in a new environment like that?
I think they need to be more customer focused, more customer process focused. Unfortunately, I spend a lot of time in banks. It was one of my biggest frustrations. I think banks are just too internally focused. Most of their communication, their emails are with each other, and they forget to talk to their customer. They forget about what the customer experience is, what the impact on the customer is. So I think that's the big change, is that the shops need to think back through to the customer experience and build their processes around that, while also having good internal processes and compliance. They have to do both. And right now, I think they've just kind of put the customer on the sideline and focus a little too much internally.
Well, Heather, while I have you with your very educated opinions on our industry, tell me how you feel about the LSP model. Do you think that that is working? Is it broken? Or do you think that most banks should move to that? Do you think it's efficient? Tell me your thoughts.
I think it can be very efficient. I mean, anytime a bank can outsource a smaller company, which is the LSP, they're more nimble. They can focus on the customer experience a lot faster and easier. So I think there's a lot of benefits to that model. I think the weaknesses for a bank are they somewhat lose their credit personality. That they're outsourcing it to somebody else, so you don't know it's not part of their brand anymore if they're outsourcing it. There's probably several ways that can be solved, and I think the benefits outweigh the weaknesses by far. Yeah.
Very good. Okay. Heather, we've gotten to work together over the years, and our team loves working with your team. Tell us about some of the reports that our team provides that have been useful for some of your acquisition deals.
Probably the most useful for a business buyer is the working capital forecast. It's not a P&L forecast. It's not just a forecast of earnings. It's a forecast of what's going to happen to their cash, their accounts receivable, payable, and inventory. And that's complicated. That is not an easy forecast for even some of our financial savvy buyers to do. So a working capital forecast is really, really important. I feel like working capital is the one part of underwriting a business acquisition that is the easiest to get wrong and also the most critical. So whenever a client can get some help with a working capital forecast and fully understand what those cash positions and those working capital positions are going to look like going forward, that's a huge help, and it de-risks the deal for them and for the bank.
And Heather, are you using any of those SBA programs for the working capital in your deals? Tell me about that.
We do use SBA Express working capital lines of credit. So our Viso method of doing this is we analyze the amount needed for permanent working capital by looking at the cash conversion cycle. We compare that amount to how much the buyer is buying of working capital and what kind of mix, if they're buying any at all. Figure out if there's a gap, ask for the gap to be covered in the term loan, the SBA term loan. And then as long as we're good on our permanent working capital, then we also ask for a line of credit that will be undrawn at close that they can use for their go forward needs. Because we know if we don't get them a line of credit when they close, they're not going to get one for at least a couple years. So we make sure everybody's got one for the rainy day kind of situation, but they've also got enough permanent working capital that's funded immediately in the deal.
For that oxygen that they need for the business,
Exactly.
for sure.
Yeah.
Very good.